markets. Seems like the opening will be good, up about close to 1% in tandem with a lot of the Asian markets. But we've seen how these things go. The closing is far from the opening on most days. Udhayan Mukerjee joins in as well into this conversation. Udhayan, hi, good morning. Volatile days is what we've had to deal with. Do you expect this volatility to continue?
Hi, Sonia. Good morning. I think right now the market's in a bit of a relief phase. We got bombed down to about 7,200 level on the Nifty, and from there's been a bit of a relief, not just in India, but across global markets. I think partly orchestrated by the kind of central bank intervention or news that global markets are expecting. I think the Fed will be very dovish today and tomorrow. The ECB is already trying to do something to douse the flames in global markets. I don't think the Fed and the ECB will be particularly successful in cooling the flames beyond the point. I think they've played out their cards. So anything that is coming through by way of relief is going to be temporary. But because markets have had such a bad start to the year, a phase of some kind of relief was always expected, and that's what's playing out right now. And I would probably give it a few more days here as well. So just in the near term, it's conceivable that the Nifty has a bit more of a bounce, maybe goes back to test the two support levels which held for many months, the first of it being 75.50 thereabouts. I think we could be headed there quite soon. That's just about 100 points away. And if the global rally continues or the global relief continues, you could even go back to that 7,700 kind of level, which was that big support which the market broke before the waterfall decline. So these are the two markers I'm looking at. I think the higher chances are to go to about 75.50 in the near term and stop there. Lower chances of it extending to about 7,700. But this, in my mind, is no more than some kind of a relief rally and in sync with what's going on globally, nothing unique to India. So you should see it in that context. But for the next few days, particularly in the run-up to the expiry and a bit beyond that, you could get some relief here.
Hi, Udhayan. Good morning. But these gyrations, you said that there's a bit of relief, but the relief seems to last for only a day. We had a monster positive day on the Dow day before yesterday, and that's Friday, and then again Monday it all got taken away. Again Tuesday it all comes back. And we've seen these gyrations and very volatile gyrations for practically the entire month. Normally, how do these volatile spikes end? Do they end with the market getting tired and therefore drifting lower? Or would they have a catharsis impact and we could probably start some build-up?
It's a difficult one to answer, Lata, but I think this kind of manic behavior is only to be expected in the first phase of what I call the acceptance phase in the market now. October to December, I think the market was in denial that there is a global problem. But everybody said, no hard landing in China, you guys are getting overwrought for no reason. So it will go away, the problem will go away, just give it some time. So come January, I think the market has generally now come around to accepting that there is a global problem. In acceptance phases, after the denial has been washed away, markets do get into this kind of a manic phase because, you're just grappling around saying, oh gosh, we have a problem on our hands. So you'll see three, 4 days of a really bad fall, then one day of a big relief rally, and then eventually the overall downtrend reasserts itself. Right now, as you correctly pointed out, it seems like the trend is fairly strong on the way down, and the rallies are therefore not lasting beyond a day or two. They're in the nature of dead cat bounces or relief rallies rather than anything more durable than that. I think once this acceptance phase comes to an end, this kind of volatility cannot last indefinitely. There might be volatility, but not this kind of intense volatility, because as you said correctly, it tires out market participants. I think what will follow right now is a phase of from acceptance. I think we'll move on to an assessment phase in the markets where people say, okay, we have a problem. Let's try and work with some numbers on how big this problem is. And the assessment phase typically comes with some lowering of volatility and the market moving into a lowish kind of a range. And to my mind, that range could be 7,200, 7,700 for the Nifty. It might last for a few weeks. This is a guess. But it could happen that the market say, okay, we've quantified the mess, and therefore let's try and work with it. What comes after this kind of a phase where the market might exhibit some ranging behavior is the more dangerous one or the tricky one to predict, because one of two things will happen at the end of this consolidation. Either the markets will go into an overreaction phase, admitting that the problem is bigger than it thought earlier, in which case you will have a last very sharp drop in prices, or it will have a return to confidence phase where the market says it's not looking like as bad as we thought it would be, and therefore the markets will bounce from there and then go into another consolidation phase. So I don't know which it will be, though the stacks are loaded, I think right now towards an overreaction phase from here on. But that's going far ahead from where we are right now. I think right now, let's hope that we get into some kind of a consolidation range, at least for a few weeks.
Okay, so consolidation is, I guess, something that the street will take with both hands. One of the bright spots, Udhayan, perhaps, is the fact that earnings this time has not been as bad as feared. Whether, if you look at the large caps, whether it was Infosys, Z, Asian Paints, Reliance, Kotak Bank, how did you read into the earnings season, not just the frontliners, but even some of the quality mid-caps?
I think you will find many more disappointments, Sonia, unfortunately, over the next couple of weeks. I wouldn't be surprised if you see a few disappointments in the big names this week itself, because you've got names like L&T, ICICI, Bharti coming up. I doubt any of them will have great news for the market. Also, I was looking at one of the brokerage notes on upgrades versus downgrades at the end of last week, and I think downgrades to upgrades is still something like 2:1 or 3:1. I'm not sure that the street will upgrade its earnings estimates by the end of this quarter at all. So, yes, there have been a couple of bright spots in a few private banks, etc., but nothing to suggest that this is the quarter which is heralding some kind of an earnings turnaround. I still think we are seeing far more downgrades than upgrades out here. And that is the problem that we have at this point in time, that compounding the global problem, our own earnings picture is not really picking up at all. So I think brokers remain quite subdued about what kind of earnings growth we'll end up with this year. I still see a lot of people talking about 17–18% earnings growth in FY17. Don't know how that will materialize out of thin air. So very, very cautious on earnings still, particularly on the top line, which is indicating that all is not well with the economy.
Actually, I was wondering if you looked at Axis Bank earnings, Udhayan. The particular fear with bank earnings is because the Reserve Bank has forced them literally to clean up balance sheets, and it will start in slow doses. The Axis Bank number is 30 basis points more in terms of GNPLs from 1.38 to 1.68. And they actually did a lot by way of even revealing to the exchange. On Monday, they also said that the quality of the remaining exposure to the indebted companies is 70% A-rated. The point is more disclosures, more than anything else. Net, what was your view of Axis Bank, and therefore what are your fears about ICICI and, of course, the PSU banks?
Different baskets of fish, different kettles of fish, Lata, out here. And I think that's one thing which the market will increasingly like to do at the end of this quarter, to sit back and say the overall compression in valuations in the bank stocks has happened. Now we start to look at which ones might be the better of the lot and which ones are the ones that you want to carry on into 2017, which is where a lot of the ugliness will come into the fore because of this SDR scheme. So I don't know whether the RBI is pushing so aggressively. It's talking more aggressively than its policy action with banks. I think it's also given the banks a fair amount of leash in the amount of time and the way or flexibility that they can come out with their bad news for the stock market. So I would have expected the RBI to be a bit more harsh on banks, given that they've been hiding their bad assets to the investing public for so long. But they've given them a window, and I think the SDR window will blow up in the banks' faces in 2017. I'm particularly worried about two banks, ICICI and State Bank of India, because I think they have hidden a lot of bad news so far, and I'm not surprised therefore at all that these are the two worst performing bank stocks over the last many weeks. Other bank stocks have not done that badly, but SBI has crumbled to 180 and ICICI Bank went down to 225, because you just look at the list of the SDRs. In almost every case, there is either State Bank of India or ICICI Bank, which is the lead banker, leading a consortium into names like Electro Steel, Visa Steel, Lanco, and IVRCL, what have you. Now, you tell me in 2017, given the state that the world is in, who's going to buy these assets of these couple of banks? I also looked at Axis Bank. I think there's one exposure which they have, probably GOL offshore, which might sting them by 400–500 crores next year. But Axis Bank looks like it's not in that bad a soup as ICICI Bank and State Bank of India would be. So if I had to look into banks right now, I would probably sit back and say, valuations having come down to more reasonable, I wouldn't say attractive, but reasonable levels, maybe there are a couple of banks you can deploy money into, but you would not want to be in a lot of the large banks, even at this point in time, because they will have to share a lot of bad news in 2017. They might hide for another 4 quarters behind this SDR scheme, but the bad news is coming sooner than later.
Okay. Well, there was a very interesting pair trade that took place in the aviation space on Monday, Udhayan. Money moving out of Indigo and into SpiceJet. How have you read into the volatility in the aviation space, and how should one approach it now?
I think Indigo will stabilize, Sonia. I know it's had a bad fall, but that's because how frothy valuations had become and how much the stock had run up after the IPO listing. It's quickly given up quite a bit of that froth and has come down to reasonable levels. I think the first day of listing it went to 850 and we are already at 900. So a little bit more of a slip and you can get Indigo once again at pretty much the listing price. We are just 50-60 rupees away from the listing price, not the IPO price. So I think Indigo will stabilize, not very much southwards from here. I'm not so alarmed by the fall in Indigo as much as the kind of volatility or unpredictability of earnings that the aviation space comes with. And that is the point which I was making to you on the day of the Indigo listing as well, that this is a space which is almost impossible to call accurately in terms of earnings. You go back and see in the last few quarters how many analysts have been able to predict an earnings of a jet or a SpiceJet accurately. I think people are generally way off the mark. Sometimes the call is for a 250 crore profit and it comes as a 250 crore loss. Even last quarter, Indigo's earnings were 600 crores plus. This quarter, suddenly after listing, you're down to 120 crores. And people are making P multiple assumptions for 17 and 18 on the basis of earnings calculations, which I think have a chance of going completely haywire. So what worries me more than any slip in this particular quarter is the assurance or predictability of aviation sector earnings going forward, because they're so fickle and move on a dime compared to raw material prices and other things. So that makes me a little unsure about the sector, but I think it's got a lot of tailwinds at this point in time, and it will remain an outperforming sector. To answer your question, maybe it may be a wise thing to own both Indigo and SpiceJet just to buffer yourself a little bit if you have to be in the aviation space. But be a bit careful about this volatility. I know there is a lot of ownership scramble which has happened in the sector after the IPO listing, but I hope you don't have shocks like what you saw with the Indigo earnings, which rattles people a little bit.
Oh, yes.